They did it. They finally did it. The key interest rate down a quarter point.
Bank of Canada lowering a quarter point to 4.75.
The first rate cut since March of 2020.
Monetary policy no longer needs to be as restrictive.
The last time interest rates went down, Joe Biden was a presidential hopeful. NASA finally picked a name for its Mars rover. Nintendo dropped Animal Crossing for the Switch. And The Weeknd's fourth studio album was a hit. Blinding Lights, a defining smash. Oh, and yes, there was something else.
And so for the first time, these words from the WHO: the coronavirus is officially a pandemic.
As more of the world shuts down, global supply chains collapse.
The Bank of Canada also made a significant announcement today, slashing the key interest rate for a third time this month.
A lot's changed since then. After 3 quick successive rate cuts, a response to the economic shock of the early pandemic, interest rates climbed in a way we hadn't seen in decades. Until today, when the Bank of Canada explained why it was time to start bringing rates down.
We've come a long way in the fight against inflation. Headline inflation has come down. Our measures of underlying inflation have been easing. They've all been moving in the right direction.
So let's try to understand why now? And maybe, just as importantly, where now? Like, where do interest rates go from here? We asked experts from every major Canadian bank to weigh in with their predictions.
This is a pretty big deal.
There could be a further one.
I'd expect another 2 cuts.
That's coming. But first, let's try to understand what those predictions are based on. So right away, by dropping the rate, everything drops right away. Loans, lines of credit, whatever interest rate you're paying, you pay a quarter point less. But the Bank of Canada has spent years raising interest rates because it's been trying to make everything else less expensive.
The cost of living, the cost of groceries, everything in Canada right now is astronomical.
How much for the gas this week? Firstborn? No, we did that last week. Can we do like secondborn and a puppy?
We can see from this graph what those pandemic years did to Canada's monthly inflation rate, peaking at 8.1% exactly 2 years ago in June. But those aggressive Bank of Canada rate hikes have gradually pushed inflation down to where we are now, a steady 2.7%. And even 2% would be better, but anywhere between 1 and 3, you're in the ballpark.
We do see renewed downward momentum in underlying inflation. The message to Canadians is we are getting closer.
Now, it's important to point out, bringing inflation down is itself a bit of a painful process. When you raise interest rates, people's finances get squeezed. Mortgages, car loans, lines of credit, they all get more expensive. And that means we spend less on everything else: furniture, food, vacations, exercise equipment. And less demand leads to lower prices. But what happens when businesses make less money? They can't afford to pay their employees as much. Wages can go down, or at least increases get smaller. And if businesses can't make the numbers work, people get laid off. Look at the unemployment rate, how it's changed over the past year. Steadily up from 5% last April to 6.1% a year later. Wage growth, too, has been slowing down for months. And the GDP growth rate in Canada has more or less stalled for the last year and a half. Those all sound like bad things on the surface, but they're also all signs that the real boogeyman, inflation, is slowly coming under control.
Our key indicators of inflation have all moved in the right direction.
So that's the good news. Inflation's coming down, and interest rates can start coming down as well. Those two things together make our lives more affordable. So now the question is, how low can they go? So we reached out to all 6 major banks in Canada. In order from biggest to smallest, that's RBC, TD, Scotiabank, BMO, CIBC, and National Bank. 3 of them agreed to give their thoughts on where they think these rate cuts are going. But let's start with thoughts on today's quarter percentage point cut.
Symbolically, this is the first rate cut. Usually there are more that follow. It suggests there's a degree of confidence that inflation is being vanquished, which is obviously quite important. It means we're moving away from those peak interest rates that have been so painful.
Well, I actually do think this is a pretty big deal, even though technically only a quarter point cut doesn't sound like a great move. The reality is this is the first rate cut we've seen in more than 4 years. Oftentimes once the central bank gets moving rates in a certain direction, they'll go that way for a long period of time.
This is a watershed moment. I mean, after a few years of rising interest rates through the first half of 2023, we've seen rates flatten out, remain stable. And now we look like we're finally headed in that opposite direction.
Next question. When's the next cut?
This is not an environment that demands further easing at every opportunity. And so the Bank of Canada probably doesn't move in July.
We're looking for September meeting as being the most probable time at which they would cut again.
They're going to sit back, watch housing and some of the key drivers of the economy to see how they perform under the lower rates.
Now, at this point, we should stop and underline something about the predictions you're hearing. They're just that, predictions.
Anything beyond the next couple months is a challenge to pinpoint on interest rates.
This is a time of high uncertainty, and we've had such unusual things happening to inflation and to the economy that you probably can't speak with as much precision as you'd like.
I think when you get out beyond that near term, there are just so many uncertainties to play out.
All of what you hear, you have to take with a grain of salt. When things like pandemics or international wars or disruptions to shipping traffic happen, they're not only completely outside our control, they often also take us by surprise. So if we can accept that, we can move on to the biggest question of all. When it comes to future cuts, how low can we go?
I think realistically, we're talking 2 or 3 of these quarter percentage point rate cuts in 2024.
What's normal, or what the target rate for the bank ultimately is somewhere around the 3% level. So about, give or take, about 2 percentage points below where we are. Our best guess is that it could take up to 2 years to ultimately get back down to around 3%, or what the bank considers to be normal.
I can envisage when we look out 18 months that short-term rates in Canada would be closer to 3% rather than 4 3/4.
In just about every case, these economists warned us anything past a few months and you're really entering into just speculation territory. You can try to model it out, but there's just only so much you can account for. The big takeaway, though, expect mortgages, loans, lines of credit to get slightly easier to pay than they might be right now, but don't expect the rock bottom rates we enjoyed for the last 10, 15 years. And because nobody actually has a crystal ball, the most prudent thing may just be to hope for the best, prepare for the worst.